Most traders do not lose because they are bad at clicking buttons. They lose because they enter the market without understanding where price is actually accepted, where it is rejected, and where the real battle between buyers and sellers is happening. That is exactly why volume profile matters. In this video, I am going to show you how to use volume profile to improve your trading, how to read the most important levels on the chart, and how to use those levels to make better entries, better exits, and fewer emotional decisions. By the end of this video, you will understand POC, VAH, VAL, high volume nodes, low volume nodes, and how professional traders use these levels to read the market more clearly.
Let us start with the basic idea. Normal volume tells you how much traded during a certain amount of time. Volume profile tells you where that trading happened on the price chart. That may sound like a small difference, but in trading, it is huge. Because candles tell you what happened over time, but volume profile tells you where the market found agreement. And when you know where the market agreed on price, you can begin to identify strong support, strong resistance, acceptance zones, rejection zones, and breakout areas. This is why volume profile is not just another indicator. It is a way of reading market structure from a different angle. Now let me explain why this matters in real trading. When price spends a lot of time and volume in one area, the market is showing acceptance. That means traders were comfortable doing business there. But when price moves quickly through an area with very little trading, that means the market did not accept that zone for long. Those areas often become powerful later because price can react fast when it returns there. So volume profile helps you separate two different types of market behavior: balance and imbalance. Balance is where the market is comfortable. Imbalance is where the market is moving aggressively. If you can see that clearly, you can stop chasing random breakouts and start trading the areas that actually matter.
Now let's break down the three levels that matter most. First, the POC. POC means point of control. It is the price level where the most volume traded during the selected period. In simple language, it is the market's most accepted price. You can think of it as the center of gravity. When price comes back to the POC, it often reacts because that is where the market spent the most energy. Next is the value area high, or VAH. This is the top boundary of the value area, meaning the upper edge of the zone where most trading happened. Then we have the value area low, or VAL. This is the bottom boundary of the value area. So the whole value area is the region where the market considered price fair. Inside the value area, price is in balance. Outside the value area, price may be exploring new territory.
Now let's turn this into trading logic. If price is moving toward the POC, that level can act like a magnet. If price is inside the value area, the market is still in balance, and price may rotate around the POC. If price reaches the VAH or VAL and rejects, that can give you a reversal setup back toward the POC. If price breaks through VAH or VAL and then holds, that can signal acceptance outside value, which may lead to continuation. This is where traders start to understand the difference between a weak move and a real move. A weak move breaks a level,
but quickly returns back inside value. A strong move breaks a level, holds above it, and builds acceptance there. That is the kind of distinction volume profile helps you see.
Now we go one level deeper. High volume nodes, or HVNs, are price areas with a lot of traded volume. These zones usually represent areas of congestion, acceptance, and heavy two-way trade. That means price often slows down there, pauses there, or reacts there. Low volume nodes, or LVNs, are the opposite. These are thin areas where the market moved quickly and did not spend much time trading. LVNs often behave like air pockets. Price can move through them fast because there is not much activity to stop it. This is why HVNs and LVNs are so useful. HVNs can give you areas to watch for consolidation, reaction, and range behavior. LVNs can give you areas to watch for breakout acceleration or sharp rejection.
If I were teaching this in a simple and practical way, I would focus on 3 setups. Setup 1, rejection from VAH or VAL. Price reaches the edge of value, fails to accept outside, and moves back toward the POC. Setup 2, POC retest. Price leaves the value area, comes back to the POC, and either bounces or fails. Setup 3, breakout through an LVN. If price breaks through a low volume area and holds, it may move quickly to the next area of interest. These are not magic entries. They are context entries. That is the difference. Volume profile does not tell you exactly where to click. It tells you where to pay attention. Then price action gives you the trigger. If you are using TradingView, keep the chart clean and white. That is important. A white background makes the profile levels and candle reactions easier to read visually, especially in a tutorial. Use a simple candle style. Remove unnecessary indicators. Use a session volume profile if you want to study intraday behavior. Use a fixed range volume profile if you want to study a specific move. Use an anchored volume profile if you want to analyze a move from a key swing point, impulse, or major event. If you are teaching this on YouTube, the chart should look educational, not crowded. The viewer should immediately see the POC, VAH, VAL, and the reaction zones.
When you show the settings, explain them simply. You can say, here I'm using a clean white chart so the audience can clearly see the volume profile structure. Then show value area percentage, POC visibility, VAH and VAL visibility, profile color adjustments, session or range selection. Do not overload the viewer with technical menus. The goal is to show them how the tool looks, not to turn the video into software training.
Now let me save you from the biggest mistakes. Do not treat every POC like a guaranteed bounce. Do not use volume profile alone without price action confirmation. Do not ignore the higher time frame. Do not clutter the chart with too many indicators. And do not confuse a fast move with a good trade. A fast move is not automatically a good move. A good trade is a trade taken in the right location with the right confirmation. That is the real edge.
Here, is the full framework. Step 1, identify the value area. Step 2, mark the POC, VAH, and VAL. Step 3, identify high volume nodes and low volume nodes. Step 4, decide whether price is in balance or imbalance. Step 5, wait for price action confirmation. Step 6, take only the setups that make sense in context. That is how you use volume profile the right way. Not as a prediction tool, as a decision-making tool.
So if you want to improve your trading, stop staring at candles in isolation. Start reading where the market accepted price, where it rejected price, and where it is likely to react next. That is what volume profile gives you: a clearer map, a better framework, and better trading decisions. If you understand POC, VAH, VAL, HVNs, and LVNs, you are already ahead of most traders who only trade patterns without context.